So if the business is a partnership business, so in this business there will be at least two partners are required, and there will be more than two partners as well. But the rule of tax is that each partner is considered as a sole trader. So it means that although the business is a partnership business, but the tax liability will be of individual partner. So each individual partner is to be assessed on the share of profit generated from the partnership. Now, the basic rule of partnership will remain the same that the students have already studied in their accounting classes, that there are partnership, there are two or more partners, there is interest on capital, there is salary of partner, drawings, and profit sharing ratio, and so on. And there is an existing partnership, then admission of partnership, and retirement of partnership. So now, how we can apply tax on partnership and how we'll calculate the profit share of partnership. So for that, we'll follow certain steps. So step number one is adjust accounting profit. We know these rules from the topic sole trader or trading income, that first we need to convert accounting profit into tax adjusted profit, considering all the expenses and income rule, including capital allowances. And remember that capital allowances are available for partnership business, not for partners. So if any asset is being purchased, whether it's a car or a plant and machinery or something like that, the rules of capital allowance will remain the same that you have already covered in your capital allowance section. Now, as we know that we have to convert accounting profit into tax adjusted trading profit. So our first step is to convert accounting profit into tax adjusted trading profit. Obviously, in our exam, lengthy calculations are not needed to convert accounting profit into tax adjusted profit, but at least you should remember all the rules of conversion, that is the allowable expenses or disallowed expenses, or the all the capital allowances rule. Then what we have to do, first we have find out the accounting profit as tax adjusted trading profit. Then we need to convert this to each partner's share of profit as per the ratio. And then for each partner we have to calculate liability, because each partner is considered as a sole trader. Now, as far as the allocation of profit is concerned, there are different items will be given in the question, that is salary of partner, interest on capital, sharing ratio. So for example, if salary of partner is deducted from the profit and loss account in determining profit for the year, then what you have to do is a disallowed expense. Salary of owner, salary of partner is a disallowed expense. So what you have to do, if it has been deducted, then you have to add it back to the accounting profit. Similarly, interest on capital, although it is to be paid by the partnership business, but is not considered as an expense, rather than it is a part of the appropriation account, and it is to be added back to. So both salary of partner, interest on capital, and sharing ratio is to be part of the profit and loss appropriation account. Usually we prepare profit and loss appropriation account in our accounting classes. So let's see how to prepare this profit and loss appropriation account from an example. So let's assume that there are two partners, A and B. The accounting year end is 31st December 2018, assuming is an ongoing business, because we know that if there is a new business, then there will be a basis period issue, and you have to apply first the basis period rule. So it's an ongoing business. Tax adjusted trading profit is 74,000. That means accounting profit has already been converted into tax adjusted trading profit. As at 1st October, the capital balances are there. A's balance is 75,000. The capital balance of B is 60,000, on which we have to apply interest on capital. Profit and loss sharing ratio for A and B is given. Salary of each partner is 25,000 per annum. Interest on capital is 5% per annum. Calculate trading income assessable for each partner. Now we have to prepare profit and loss appropriation account in order to find out the value. So let's deal with this. So a profit and loss appropriation account will look like this. So you can see a column of total and first partner and second partner. Now, first of all, consider salary of each partner. So total salary is 50,000 as each partner gets 25,000 each for the whole year. Now, after that, another payment is or expense is interest on capital that we have to deduct first from the profit. And for interest on capital, we have seen that the capital is 75,000 and 5% is the rate. So for A is 75,000 multiplied by 5%, and that becomes the value becomes 6750, and for B the value is 3750, and the total becomes just a minute, the value is there's a bit mistake in the calculation, so calculate it again. 75,000 into 5%, and that becomes 3750, and 60,000 into 5% per annum, and that becomes 3,000. So that total is 6750. So this is interest on capital. So now let's see how much is the total expense that we have to deduct it from the profit before sharing the profit. So the total amount of expense is 5750. Here the A will get this one, B will get 28,000. Now, the residual profit. So in order to find out the residual profit that is to be shared between partner, first of all, let's see that how much is the profit is there. So our profit was 74,000. So profit was 74,000. So from 74,000 profit, the total value of payment is 56,750. This has to be paid by partnership business. So the remaining profit is to be shared between these two partners in the ratio of 60:40. So 60 will belongs to our first partner, and 60% share becomes 10,350, and 40% shares become 6,900, and the total becomes 17,250. So in this way, this is becomes the total profit. Original 74,000. This is the total allocation to A. This is the total allocation to B. This is 39,100, and this is 34,900. So in this way, we have converted the profit for each partner. Now each partner is accessible on the respective profit sharing. If they have another source of income, then we have to calculate it normally as per the non-saving, saving, and dividend rule. Now, sometime it happens that there will be a change of profit and loss sharing ratio during the year. Now, how to deal with this? You have to split the profit into two parts, before profit and loss sharing ratio, and then the changed profit and loss sharing ratio. So we can understand with the help of this example. So let's work out this example. A and B are partner. Accounting year end is 31st December 2018. Tax adjusted trading profit is already there, 16,500 up to September 18. That means till September 18. So for example, from January to September, then October, November, December. So for first 9 months, the sharing ratio was 3:2, and annual salary was decided at 3,000 and 2,000 respectively. It's annual salary. From 1st October onwards, ratio is now 2:1 after allocation of an annual salary of 6,000 and 4,000 respectively. Calculate trading profit assessment of each partner, that is A and B. Now let's work it out how we can do it. We have to split it in 9/12 and 3/12. So let's make the allocation. So first of all, the total column, then partner A, and then partner B. So from you can say 1st January 18 till 30th September 18. So it's 9 months, and we have been given the salary for the annual salary. So we have to split salary for the 9 months, that is 9 by 12. So the salary was, original salary was 3,000 and 2,000 per annum. So you have to convert 3,000 and 2,000 into 9 by 12. So for 3,000, the 9 by 12 value will be 2250, and 2000 value will be converted into 1500. So total salary is 3750. I have do it in this way: 2000 annual salary and 9 by 12. Now, there's no interest on capital, so you have to identify the balance of profit. So let's see that the total profit share that we will get from 9 by 12 is, total profit was 16,500. Let me check it again: 16,500, and the proportion is 9 by 12. So the total profit share was 12,375 for the first 9 months. Now, uh, take the balance. Balance is 8625. This is the balance of the profit. So you can say that your balance has to be shared between these two in the ratio of 3:2. So this is the ratio, 3:2. So A will get accordingly 5175, and B will get 3450. So in this way, we can identify their share. Now, as far as the next period is concerned, that is from 1st October 18 till 31st December 18. This is the next period. So again, you have to split salary because the salary has been changed now. And now the salary is 6,000 and 4,000 respectively. So for 6,000 and 4,000, the relevant share is 1,500 and 1,000. So total salary for the 3-month period of both partners is 2,500. Now the remaining profit share is for 3 months. Let's split profit for 3 months. So it's 60,005, 3 by 12, and that becomes 4125. So the balancing figure is 1625, and you have to share in the ratio of 2:1. 2:1. So as per 2:1, A will get 1083, B will get 542. So hence the total profit share can identify 9 months and 3 months. So that becomes 10008, and this is 6492. So this plus this and this plus this. So this is the 12-month profit share. So A has to pay tax on this, B has to pay tax on this, and they have to calculate their income tax liability. Now let's assume that there will be a start of partnership. So we know that if there is a commencement of business, then we have to apply the basis period rules that we have already discussed in the basis period calculation. So as far as the commencement of business is concerned, we have to identify first the basis period and then the assessable profit. So let's deal with this in this example. So we have two partners, Mr. A and B, and they have commenced a partnership business on 1st January 18. So the commencement date is there, and the accounting year end made by them first is 31st December 2018. So that means it's a case of a 12-month period of account. So you have to follow the rule of a 12-month period of account, and the profit that is given is 100,000. Profit is there, right? So or the profit of the next year is 80,000, right? Profit and loss sharing ratio is 50-50. So we have to convert. as per the ratio, calculate assessable profit of each partner for 17-18 and 18-19, and also calculate the overlap profit. So let's calculate this. So as per the format, we have to identify tax here, and then the basis period, and then the assessable profit. So as per the rule, we have to identify the date of commencement, that is 1st January. So we'll start from 1st January 18, and it'll go for 5th April 18. This is the actual basis, and that actual basis come to 3 months. So you have to identify 3 months profit. What was the original profit for the year? 100,000. So first of all, the 100,000 is for 12 months, then 3 by 12 and divided by 2, because the sharing ratio is 50-50. So that's why 25,000 share divided by 2. So each partner will get a share of 12,500. Let me put the partner's name here, and that is A and B. So let's split there accordingly, 12,500 each. And the tax year becomes 17 and 18. Now the second tax year rules, and as per the second tax year rule, the accounting date 31st December 18 falls in second tax year, that is 18-19. So we have the rule of 12 month. So in the case of 12 month, I have to complete the whole year from commencement till 31st December, and as a result there will be a duplication of profit. So I have to take full 100,000 profit divided by 2 due to the partnership share. So each partner will get profit share of 50,000, and the tax year would be 18-19. Now from these two above dates, you can see that clearly there is an overlapping of the period from January to 5th April is in this date, included in this date. So there is a clear overlapping case, and the overlapping is as per the date. Overlapping date is 1st January 18 till 5th April 18. There is an overlapping, and you can say for each partner the overlapping is 12,500 for each partner. So each partner assessable income is 12,500 for 17-18, 50,000 for 18-19, and there is an overlapping profit which the partner will get benefit when the business will end, or there will be a change of accounting date. Now let's see the case of an admission of partner in an existing partnership. So from the question, let's see how to deal with this new partner. As far as the basis period rule is concerned, the existing partners, for existing partners, the basis period rule will be for ongoing business, and for a new partner, it will be a case of commencement. So let's see, A and B were in partnership. A and B were in partnership since 1st July 2016. It's their commencement date, preparing accounts to 30th June. And then from 1st July onwards, C joined partnership and sharing profit and loss equally. So profit and loss shared equally means between A and B, and now between A, B, and C. The tax adjusted trading profit detail is there. Accounting year end is June 17. That means the period of account is of 12 months. The profit was 10,000. So it means it is to be divided between A and B as 50-50. And for 30th June 18, again, 13,500 is to be divided between these two partners. But from 1st July 18, now there are 3 partners. So this 18,000 is to be divided between 3 partners equally, that is 6,000 each. Now we have to identify the assessable profit for each partner. So let's work it out. So first of all, let's start from the partner A and B. So for A and B, let me do some working. That is tax year, and we have basis period, and the assessable profit for each partner A and partner B. Now let's work it out. So the commencement date was 1st July 2016. So from the commencement date, you can say that 1st July 16 to 5th April 17. So this is considered to be 9 months, and the 9 months profit, we have to consider the 9 months profit. So the profit was 10,000, 10,000. So 10,000 multiplied by 9 by 12 divided by 2 to each partner, and this becomes 3750 each. So this is the profit that is to be assessed in the tax year 16 and 17. Now, as far as the rule is concerned, for 17 and 18, we'll start from 1st July again, as the account is of 12 months, and go for 30th June 17. So 30th June 17 means the tax year becomes 17 and 18, and the profit is total 10,000 now divided by 2, as there is an equal ratio, so 5,000 each. So in this way, I can say that there's an overlap of profit of 3750 to each partner. Now, from subsequently, from 18 and 19 onwards, this becomes the current year basis, that is 30th June 18 for them, and for 19 and 20, again current year basis, that is 30th June 19. So the profit for 18 and 19 was 13,500 and 18,000 each. So we have to divide profit. 13,500 divided by 2, that is 6750, 6750, and 18,000 divided by 3 now. Here the profit is 18,000 total. Now there are 3 partners. So the share of profit of each partner is 6,000. So they both will get 6,000. Now, as far as the third partner is concerned, so let's now work for third partner. So we have the partner C. For partner C, let's work out its basis period and assessable profit. So for partner C, partner C joint partnership from 1st July 18. So from 1st July 18 till 5th April 19, that is 9 months profit. So his share was 6,000. So 6,000 multiplied by 9 by 12. So the profit assessable is 4,500, and the tax year becomes 18 and 19. And the next period would be 1st July 18 to 30th June 19. And in this case, the year becomes 1920, and the profit will be whole 6,000. So the overlap profit of 4,500 for partner C. Now, as far as the losses are concerned, the rule for relief of loss is almost same for partnership, because they are treated as sole trader. So for each partner, if there is a year of loss, what are the options available for each partner? That is simply the same options the partner can use to carry forward current year trading losses with the next year profit. They can use current year total income option. Remember the cap. Or they can use carry back 12-month carry back option as well. And if there is opening year of partnership, then it would be right opening year rule, and first 4 year of loss will be carry back for last 3 years, that is 36 months. And if there's a cessation of business, then partner can get terminal loss relief. This is for those partners which have decided to quit partnership, and for them the year would be a cessation, and for the existing partnership business there will be an ongoing partnership rule. So this is the same for the existing partner.